Silver did not ease into the final days of December 2025. It lunged. What had been discussed for months as a distant possibility suddenly became a lived reality on trading screens and, more importantly, inside physical bullion shops across the United States. Prices that once sounded hypothetical moved into everyday conversation. $58 an ounce. $60 an ounce. Then talk of $70. For dealers on the ground, this was no longer a chart pattern or a speculative narrative. It was uncharted territory unfolding in real time. The original discussion made one thing clear early on. These were not ordinary price moves. Swings were widening, not narrowing. Volatility was accelerating rather than calming down as new highs were reached. The language coming from experienced bullion dealers was cautious, almost defensive. Not because they doubted higher prices were possible, but because the market was moving faster than the infrastructure around it could comfortably absorb. When silver moves $5 or $6 in a short window, traditional assumptions about liquidity, premiums, and replacement costs begin to break down. That sense of instability was reinforced in the final week of December, when silver briefly surged above the $80 per ounce level, before pulling back sharply amid profit-taking and tightening financial conditions. Intraday moves of several dollars became common, not exceptional, and the gap between headline prices and executable prices widened. For the first time in years, many market participants were forced to confront the uncomfortable reality that spot price and real price are not always the same thing. What made this moment different was not just how high silver went, but how it got there. This was not a slow grind higher driven by steady accumulation. It was a market reacting to stress. Dealers described conditions where prices were changing faster than inventory systems could update. Quotes expired within minutes. Buyers hesitated, sellers rushed, and everyone understood that the next price tick could materially change the economics of a transaction. The key point, often missed by casual observers, is that markets do not become safer when prices rise rapidly. They become more fragile. Silver's move into these elevated levels did not signal stability or equilibrium. It signaled tension. And as the last days of the year showed, tension in commodity markets has a habit of resolving itself in ways that surprise both optimists and skeptics. Inside physical bullion shops, the silver rally looked very different from the clean lines on a price chart. This was not a market calmly discovering value. It was a market colliding with its own mechanics. Dealers described days that felt less like routine trading and more like emergency response. Phones ringing constantly. Customers lining up to buy and sell at the same time. Transactions stacking back to back, with no pause to reassess inventory or risk. Lunch breaks disappeared. So did the illusion that price alone tells the full story. One detail from the original discussion matters more than most headlines admit. Silver was not simply at $60 an ounce. It took $60 to buy an ounce. Spot prices lagged behind the lived reality at the counter. When quoted prices hovered just below that level, physical silver was already trading higher, quietly confirming what paper markets had not yet acknowledged. In practice, the market was front-running itself. That gap only widened as volatility increased in the final week of December. During several sessions marked by sharp intraday swings, physical dealers reported pricing uncertainty tied directly to rapid COMEX fluctuations, with some quotes becoming obsolete within minutes. In extreme cases, dealers delayed large transactions altogether, waiting for the futures market to settle before committing capital. This was not caution for its own sake. It was survival. What makes this moment uncomfortable is how exposed the system becomes when prices move faster than replacement inventory can be sourced. Dealers are not speculators betting on price direction. They are intermediaries. They buy, sell, and restock. When the restocking price becomes a moving target, margins compress instantly. A dealer who sells silver at what looks like a generous price today risks paying even more to replace that same ounce tomorrow. This is where the narrative often turns upside down for the public. Rising prices do not automatically mean rising profits for bullion shops. In fact, they often mean the opposite. The faster silver climbs, the more capital it takes to stay in business. Cash flow becomes strained. Inventory decisions become defensive. and some shops quietly stepped back, limiting purchases or pausing buying altogether. Not because demand is weak, but because the risk is too high. From the outside, the rally looked euphoric. From behind the counter, it looked fragile. And that contrast is the first warning sign that this silver market is being driven by forces far more complex than enthusiasm alone. As silver pushed higher, the flow of people through bullion shops revealed a market divided by experience. The original discussion made a careful distinction that matters more now than ever. This was not a single wave of buyers moving in the same direction. It was several different groups reacting to the same price shock in very different ways. New buyers arrived with a familiar regret. They spoke openly about missing lower prices, about wishing they had acted when silver was trading in the teens or 20s. Their urgency was emotional rather than strategic. Many wanted immediate exposure, often focusing on headline prices rather than spreads, premiums, or exit liquidity. In calmer markets, this type of buyer provides steady demand. In a volatile one, they tend to arrive late and leave quickly. Experienced stackers behaved differently. Many of them were already sitting on significant gains, having accumulated silver at $12, $14, or $20 an ounce years earlier. Instead of chasing the rally, they focused on cost averaging or rebalancing. Some continued adding ounces, accepting higher prices in exchange for long-term positioning. Others began trimming exposure, not out of fear, but out of discipline. Then there was the third group, the most telling one. These were holders trading silver for gold. As silver surged to new highs, their stacks had become disproportionately weighted toward one metal. Swapping silver into gold at elevated ratios was not panic selling. It was portfolio management. This behavior rarely makes headlines, but it speaks volumes about how seasoned participants view the rally. They are not betting on a straight line higher. They are planning for volatility. Recent market behavior reinforces this divide. In the final week of December, sharp pullbacks following record intraday highs showed that short-term speculative money exited quickly, while long-term physical holders appeared far less responsive to price drops. Selling pressure spiked in futures markets, yet reports from physical dealers suggested fewer panic sales of bullion than many expected. The contrast was striking. American investing culture has a habit of romanticizing late entries. There is always a belief that one more push higher will justify the rush. But silver is not a technology stock. It does not reward momentum alone. It rewards patience, timing, and an understanding of cycles. What the foot traffic inside bullion shops made clear is that this market is no longer driven primarily by curiosity. It is driven by strategy. And when a market shifts from curiosity to strategy, price behavior becomes far less forgiving. As silver prices accelerated, the most misunderstood casualty of the rally was not the investor, it was the dealer. The original discussion laid this out with unusual honesty, stripping away the convenient myth that bullion shops automatically thrive when prices rise. In reality, the opposite often happens. When volatility explodes, dealers are squeezed from both sides, caught between customers demanding strong buyback prices and refiners quietly lowering their bids. At the center of the problem is premium compression. As silver moved into the upper price ranges, premiums that once padded dealer margins began to evaporate. Products that previously sold comfortably above spot were suddenly trading at spot, or even below it. This was not generosity, it was math. Refiners, facing their own exposure to price swings, adjusted first. They pulled bids lower, sometimes significantly, forcing dealers to follow or stop buying altogether. Replacement cost became the silent killer. A dealer might sell silver today at what appears to be a solid price, only to discover that replacing that same inventory tomorrow requires more capital than expected. The faster prices move, the greater the risk. In such an environment, margins shrink not because demand is weak, but because uncertainty is expensive. This dynamic intensified in late December. Following several days of extreme intraday volatility, refiners and large wholesalers reduced buyback levels by additional percentage points to hedge against rapid price reversals. In practical terms, this meant dealers were often paying customers less for silver even as headline prices continued to climb. For the public, this felt unfair. For dealers, it was survival. The predictable reaction was withdrawal. Some shops quietly capped daily purchases. Others stopped buying entirely for short periods. Not because silver was unwanted, but because cash flow constraints made continued buying reckless. Running a bullion business at $60 or $70 per ounce is fundamentally different from running one at 20. Each ounce ties up more capital, and each mistake costs more to fix. Here is where the market turns ironic. The louder the rally becomes, the thinner dealer margins get. The more bullish the headlines, the more defensive the intermediaries must be. This is not a sign of market health, it is a sign of strain. And when strain builds at the dealer level, liquidity eventually suffers. Silver's rise exposed a simple truth. A soaring price does not guarantee a functioning market. Sometimes, it reveals how fragile that market really is. One of the most revealing developments during this rally was not the price itself, but what quietly disappeared from the market. Certain forms of silver that had long been treated as routine inventory suddenly became difficult to source. Constitutional silver, the 90% coins that dealers once assumed would always be available in bulk, began to vanish from wholesale channels. For many shops, this was the first real signal that something deeper was happening beneath the surface. The original discussion highlighted the surprise felt by dealers when wholesalers reported being out of stock on items that historically represented the most reliable supply. These were not exotic products or collector pieces. They were the backbone of everyday silver trading. When those channels dried up, even temporarily, it forced dealers to confront the uncomfortable difference between overall silver availability and usable market supply. This distinction matters. A market can have plenty of silver in aggregate while still suffering from localized shortages. In late December, that is exactly what emerged. Reports from multiple segments of the supply chain indicated that certain regional inventories were drawn down to multi-year lows, particularly for products favored by retail investors and small dealers. At the same time, industrial users continued to absorb silver steadily, reducing the amount circulating back into the investment market. The result was a kind of selective scarcity. Silver existed, but not always where it was needed, and not always in the form buyers wanted. Dealers received odd weight bars, uncommon rounds, and mismatched lots. Standardized, easily resold products became harder to replace. This imbalance increased friction in the market, slowing transactions and amplifying price sensitivity. There is an irony here that deserves attention. Analysts often dismiss reports of scarcity by pointing to global production numbers or above-ground estimates. But markets do not function on estimates. They function on deliverable inventory. When common products disappear from circulation, confidence erodes quickly, even if total supply has not collapsed. What this phase revealed was not a global silver shortage in the dramatic sense, but a breakdown in distribution efficiency. And distribution breakdowns have a way of magnifying price moves far beyond what fundamentals alone would suggest. In that sense, the scarcity being felt was less about running out of metal and more about running out of margin for error. As physical markets strained under volatility, the paper market stepped in with a familiar response. Not with reassurance, but with tighter rules. The futures exchanges, led by COMEX, reached for their most reliable braking mechanism: higher margin requirements. To experienced traders, this was not shocking. It was almost expected. When prices move too fast, leverage becomes the pressure point regulators and exchanges target first. In the final days of December 2025, that pressure point was activated. COMEX raised margin requirements on silver futures contracts by roughly 10%, a move that immediately altered the risk calculus for leveraged participants. For those holding large positions, the message was simple: post more capital or reduce exposure. The market's reaction was equally direct. Prices fell sharply in the sessions that followed, with intraday declines large enough to wipe out weeks of gains in a matter of hours. This sequence is critical to understand. Margin hikes do not change supply. They do not change demand. What they change is participation. Leveraged traders, especially short-term speculators, are forced to liquidate not because their thesis is wrong, but because their balance sheet cannot absorb the new requirements. This creates sudden selling pressure that has little to do with fundamentals and everything to do with mechanics. The original discussion warned that swings would grow larger once silver moved beyond the $50 level. That warning proved accurate. During the margin adjustment period, silver experienced multi-dollar intraday moves that would have been considered extraordinary in previous cycles. These were not calm corrections. They were mechanical air pockets. There is a bitter irony in how this plays out. On one hand, exchanges argue that higher margins reduce risk. On the other, they often amplify volatility in the short term by forcing synchronized exits. Retail investors watching the tape see chaos. Professionals see a familiar pattern. The rules of the game have not changed, only the speed at which they are enforced. For physical holders, this paper-driven turbulence creates confusion. Prices drop rapidly, but premiums do not always follow. Dealers remain cautious, unwilling to chase futures. Prices lower when replacement costs remain uncertain. The disconnect between paper corrections and physical pricing widens further. What COMEX demonstrated once again is that the silver market is not governed by sentiment alone. It is governed by leverage limits. And when those limits are adjusted, price discovery becomes less about value and more about survival. This does not end rallies, it reshapes them. When the dust settles, the silver market leaves behind an uncomfortable conclusion. This was never about a straight line to higher prices, and it was never about silver as a shortcut to wealth. The original discussion was clear on this point, and the events of late December only reinforced it. Silver behaves less like a speculative asset and more like a stress indicator for the financial system itself. At elevated price levels, silver stops acting politely. It exposes weak points. It reveals how dependent modern markets are on leverage, smooth logistics, and stable assumptions. When those assumptions fail, even briefly, silver reacts violently. Not because the metal has changed, but because the system around it has. That is why rapid gains are often followed by equally rapid pullbacks, and why confidence evaporates faster than it forms. Recent behavior underscores this role. In the final trading days of December, investor positioning data and dealer activity suggested that silver was increasingly being treated as a strategic hedge rather than a short-term trade. Longer-term holders showed less urgency to sell during sharp pullbacks, while speculative volume fluctuated aggressively around margin changes and macro headlines. This split tells a deeper story about motivation. One group is chasing price. The other is hedging risk. For American investors, this distinction matters. Silver is often marketed as protection against inflation, currency debasement, and systemic instability. But protection is rarely comfortable. It comes with volatility, drawdowns, and long periods of frustration. Anyone entering the market expecting smooth appreciation is almost guaranteed disappointment. Those who understand silver as insurance, not a lottery ticket, are far less likely to panic when prices swing. There is also a broader irony at play. As technology accelerates, debt expands, and financial products grow more complex, a dense, unproductive metal continues to attract attention precisely because it is simple. It does not default. It does not require counterparty trust. It does not depend on software updates or regulatory reinterpretation. In moments of stress, that simplicity becomes its strength. Silver's recent surge was not a finale. It was a signal that the system is under pressure, that volatility is not going away, and that the gap between paper representations and physical reality continues to widen. Markets like this do not reward impatience. They reward preparation. If nothing else, the past few weeks have made one thing clear. Silver is not just reflecting demand for metal, it is reflecting confidence, or the lack of it, in everything priced around it.